Stocktwits Nation. It is Thursday, May 15th. I'm here, as always, with Shay, Boloor, and we have a special guest today, Michael Sonnenshein, COO of Securitize. Welcome. It's great to have you here. How are you doing today?
I'm great. Great to be here. Thanks for having me.
Amazing. Well, you guys have been following all week. We have a big crypto focus this week, which has been really, really fascinating. So, Michael, I'm so excited you're here because I know Shay and I both have a ton of questions for you.
Sure.
As was the case yesterday, we're going to start off. We're going to pick Michael's brain on tokenization and everything he's building over at Securitize. And then the back half of the show, we'll go back to the typical TradFi stock market news that we typically cover on the show. So excited to have you here. Let's start at the top. What is Securitize for people who aren't familiar? What do you guys do, and what value are you adding to the investing ecosystem?
Yeah, sure. So Securitize is an end-to-end tokenization platform. We're the largest in the industry. So today we've brought about $4 billion of tokenized investments onto public blockchains. We believe that the on-chain economy, the on-chain investor, is starting to think about new investment offerings, a new way to diversify their holdings. So we work for traditional asset managers like BlackRock, VanEck, Apollo, really helping them to bring their typical traditional fund offerings that are typically offered through traditional channels and on traditional rails, instead offered onto public blockchains. So on one side, we work with asset issuers like the folks I just mentioned, and on the other side, we work with public blockchains like Ethereum, Avalanche, Solana, Inc., Optimism, you name it. And so we really sit at the center of what I'm calling kind of the tokenization race, where you're seeing asset managers wanting to get greater distribution of their products by bringing them onto public blockchains, but also avoiding the need for tokenization just for the sake of tokenizing, right? People want to make sure that if they are going to move these assets onto public blockchains and you're going to have investments in your wallet, that you unlock better utility on those investments. And there's certain features, certain attributes of these investments that we're able to facilitate sitting in a wallet on a public blockchain that candidly you just can't do in a traditional sense. And hopefully we can get into some of that this morning.
Right. And Larry Fink at BlackRock has been pounding the table on the
Yeah.
private assets. So it's fascinating to see kind of you all's relationship there with him. I'm curious, just what is the benefit? So for BlackRock, if they want to take some of these assets, whether it's PE, VC, whatever it is, they want to make that more accessible. Why is tokenization and sort of getting off the typical rails, why is that necessary?
Yeah, so in the case of BlackRock, our relationship with them started about 2 years ago, and so far we've brought one product to market together. That product is a U.S. Treasuries fund. The token is called BUIDL, B-U-I-D-L. And this is an institutional product, right? It has a $5 million minimum investment. And when you think about the types of investors that are using U.S. Treasuries, it's really U.S. Treasuries that make capital markets go round. Investors are using U.S. Treasuries to collateralize their trades. Money market funds are typically invested in short-term dated U.S. Treasuries. But so on the surface of it, the BlackRock fund that we've launched isn't that exciting. It's just a tokenized fund that holds U.S. Treasuries. But here's where it starts to get interesting. Typically, when you hold treasuries or you hold a money market fund, you actually get the dividends on a monthly or sometimes even quarterly basis. Bringing this fund on-chain, investors actually get their dividends on a daily basis. So as an investor, you get your access to capital much, much faster. You also have the ability to mint and redeem your investment on a daily basis and almost instantaneously. Whereas when you think about a typical money market fund or even just buying U.S. Treasuries directly, you have to deal with order cutoff times, or if the bond market is closed, or if it's a national holiday or a banking holiday, things like that. So objectively here, we actually feel like we are adding value in ways that are just not able to be achieved on traditional rails. And that's why you've seen in just the last like 13, 14 months since we launched that fund, over $3 billion has come into it. And we believe we're still just kind of in the earliest innings of where and how the fund will be used.
It's fascinating stuff. And also when you think about, Shay and I have been not deep diving, but talking a lot about brokerages and the investing ecosystem. We had an interview with Vlad from Robinhood. He has also been talking a lot about tokenization. So I'm curious, at first look, it seems like tokenization would really disrupt the brokerage model, but it looks like it's more of a collaboration, at least in the near term. So from your seat at Securitize, when you hear someone like Vlad at Robinhood, other brokerages kind of leaning in this direction, where do you see you all fitting within that landscape?
Yeah, so I think if you take a big step back, investor behavior is changing, just generally speaking, right? When I think back to when I first got into the crypto space about 11, 12 years ago, and even to this day, there's been a lot of obsession with like the user experience and like, will Katie's grandma, will my grandma be able to like have a crypto wallet and be able to pair like a public address with a private key and things like that. And obviously we know it's become orders of magnitude easier for people to interact with crypto assets directly. And so I think as we're seeing more pervasiveness around wallet infrastructure and what can be put in a wallet, it starts to beg the question of wealth and investing. And wealth and investing now is broadly in two camps. You have your brokerage or like your investment account over here, and then over here you have like your wallet and your crypto assets, right? And so like today these are they've been separated. And when we look at this at Securitize, and I think other people such as Larry Fink, who you mentioned, or even Vlad, you have to consider whether or not what's typically available to you today in a brokerage account, stocks, bonds, ETFs, mutual funds, etc., are going to sooner be available to you through tokenization in a crypto wallet, or will the assets in a crypto wallet today, like Bitcoin, Ethereum, etc., be sooner be made available to you in a brokerage account? And ultimately, what we're starting to see is a convergence between the two. If I was a betting man, I'd say what's typically available to you in your brokerage account will sooner be available to you in your wallet than the other way around. And that's why I think organizations such as mine at Securitize are really pioneers in really trying to make tokenization as accessible, secure as possible. And that's why we're getting the traction that we are with the various asset managers and public blockchains.
Yeah, and on the asset manager side, in addition to the VanEcks, the BlackRocks, would you or are you working directly with any VC firms to improve access to their portfolio or PE? Would you work with those types of parties directly, or is there an intermediary there that would be in play?
Yeah, so we've done venture funds as well, for folks like Parify and Blockchain Capital. What we're starting to see now is that, generally speaking, the more liquid the underlying asset is, and the more frequency there is to buy it and sell it, or subscribe and redeem from it, generally speaking, the better a candidate it is for tokenization. So we are starting to really experiment with both the underlying product structure as well as the underlying investment exposure. So it's not just US Treasuries. A project we did last year was with actually a New York Stock Exchange listed company called Exodus, EXOD. If you're an Exodus shareholder, you can actually take your shares, push them back to the transfer agent, and then take tokenized Exodus shares back into your wallet, right? So we're starting to also be tokenizing public equities as well.
Interesting. And then some of the direct use cases you mentioned, the private investment opportunities, as Larry Fink has been talking about. We also talk about things like that we were talking about a few years ago when NFTs were big, music royalties, sports teams. Like, what are some of the more interesting use cases that either people are talking about in your space or that you're actively building towards as people expand what they think about what's actually possible to be owned?
Yeah, so our focus at Securitize is really on the tokenization of securities. So that doesn't mean that we don't see all kinds of other things come our way, whether it's real estate or anything from rights, warranties, it could be loyalty, like you're talking about with sports teams, things like that. But I think there's a difference between just tokenizing just to track transfer of ownership and just general using public blockchains as a ledger through tokens versus what we're doing with securities, in which case we're actually trying to leverage the underlying technology to create a better user experience, better or more frequent access to capital, or unlocking some other utility, right? What's so interesting about things like the BlackRock fund and some of the other products we offer is that when you think about them again in their like traditional sense, like a money market fund isn't that exciting. It's like if you have some cash laying around, you generally just sweep it into the money market fund because you think about it as like a safe, yield-bearing place. But in tokenized form, you can actually instead take that as a form of collateral to then underwrite your trading or post it to an exchange or an OTC desk, whatever it may be. And so it starts to like take on a whole different identity in tokenized form than kind of its traditional counterpart does. And that's really, I think, some of what we're really trying to accomplish with tokenizing securities.
Yeah, and I want to ask you, I saw this morning some big news, not directly involving your company, but the DeFi space with the MoonPay MasterCard. I don't know if you caught this. So there's a big deal, and basically MasterCard's bringing stablecoin cards to over 100 million merchants. And this seems like the kind of the biggest lean forward of this movement we've had recently. I'm curious if you've had any general thoughts on that as someone who's building adjacent to that space.
Yeah, so the stablecoin space is heating up very intensely. Obviously, you have some stablecoins that have kind of a pole position in terms of market size, like USDC and Tether and things like that. But I think, again, investor behavior is changing. And for a lot of investors who haven't historically had the underlying yield from those stablecoins shared with them are now demanding that it does get shared. So you are starting to see a lot more stablecoins getting launched. And again, I think for a lot of users, like, if I Venmo or Zelle Katie, like, most people don't know and don't really care what's going on in the background as long as like I no longer have the money and you now do. And so I think you're going to start seeing stablecoin rails, whether it's through debit cards or like MoonPay and MasterCard can facilitate, or just directly using stablecoins. You're going to start seeing more use cases how they're just going to start to facilitate seamless and kind of frictionless payments. What's also been interesting about this is that as there's more stablecoins coming to market, investors are increasingly scrutinizing what the stablecoin issuers are investing the underlying stablecoins assets in. And so that's actually an area where Securitize has been participating because we offer these tokenized treasury funds like BlackRock's BIDL and VanEck's VBIL. Investors want the transparency of what the stablecoin is invested in, and it's nice for them to see that in an on-chain environment that oftentimes a lot of the reserves are being invested in things like tokenized treasuries and the products we offer.
Mm-hmm. And I listened to an interview you did a couple months ago with Bloomberg talking on the policy front and sort of the shift, the dramatic shift between administrations of how they feel towards crypto and how policy is being enforced. Wondering if you could articulate that for our audience and also share any insight you have in terms of how collaborative companies like yours are with the government right now. How much are you working alongside lawmakers? I think a lot of people, Shay, myself, sometimes we watch these hearings and we're like, I can't believe these people are making the laws. So we would hope they would lean on experts like you. Let's talk policy shifts and also where you all fit into that ecosystem.
Yeah, it's a great question. Like said succinctly, things are changing rapidly. Even in just the last few months, things have changed rapidly since we have a new administration in Washington. I think over the last decade or plus that I've been involved in the space, you've really seen not a tremendous amount of movement in the US around crypto regulation. Yes, we've had some wins, like recognition of Bitcoin and Ethereum as commodities and some guidance from the IRS on how crypto is to be taxed. Grayscale at my old company, we famously had a lawsuit against the SEC to unlock Bitcoin ETFs, which we won. But there was generally like a prevailing temperature that previously was spoken to our industry that said, come in and talk to us, come in and talk to your regulators, and we'll figure this out together. And unfortunately, not a lot of progress was made there. Nowadays, under this new administration, the SEC has a dedicated crypto task force that is taking multiple meetings on a daily basis with crypto participants. Companies like us, we've been in to see the SEC. They're engaged. They want to know what we're doing. They want to know how they can help. They want to understand what our thoughts are on existing rules and regulations and how they may or may not apply to some of the products or services we or other companies may be offering. You're also seeing some movement, I think, on the state level with a bunch of states passing laws to establish reserves, like Bitcoin reserves at the state level, and then also seeing legislation passing through Congress around stablecoin legislation. So generally speaking, I would say we're very optimistic, and thus far, even just in this last SEC crypto roundtable they had this week, the new SEC chairman said he wants to make the United States the crypto capital of the planet. I mean, that is such a different tone and temperature from where we were even just 6 months ago. So I think from my seat, we see it as very encouraging.
Yeah, we had some guests on earlier this week, and we got into talking about this weird dichotomy between, as you say, embrace of these new technologies, DeFi, crypto, and then an embrace to the point of now there's like meme coins associated with political figures. And we were talking about how interesting that is, because directionally you could say, okay, yeah, that's supportive of a movement. The guests were saying, sometimes I think that detracts from the serious work that's being done. I'm curious if you have any thoughts or opinions on those two things sort of happening in tandem. You have the meme coins, and then you have this real, legitimate work and collaboration that's happening so the U.S. can actually lead in this space.
Yeah, so I think that's a really great point. And when I have opportunities to speak publicly like this, I try and encourage my fellow companies and builders in the crypto ecosystem. Let's not, take the inch or a couple inches that, our regulators are giving us and the attention and time they're giving us right now, and squander the opportunity by running afoul of existing rules or regulations. Let's use this opportunity to work collaboratively with them to build the right frameworks so the U.S. can in fact be that. We don't want to have us, be seen as a amateurish ecosystem or folks that don't comply or can't comply with rules and regs. And not to say that meme coins specifically are or not, but they're certainly not the first and foremost use case of the kinds of things we're trying to build within the crypto ecosystem.
Yeah, I think the fascinating thing about that, it applies to a lot of industries, is the things that are easiest to talk about are the most surface level, the meme coins. It's a lot easier to post on social media about the Melania coin than to get into the depths of tokenization. And it is almost like a communication marketing challenge that people like you face in how do you keep people focused on the big stuff that's going to change our financial system as these other things are happening that are much easier to comment on.
100%. But listen, we're in the early innings of it, and I do think you're going to see a lot of progress this year.
Yeah. I also wanted to ask you, so reading up on you, you were really pivotal in the spot Bitcoin ETF and bringing that to market at Grayscale, and you're sort of known for that. I'm curious, at Securitize, is there a similar thing that you are looking to push forward or get done that would be your milestone at this next stage of your career?
At this point, I don't want to reveal too much about the direction that we're going. But I think the combination of what we're seeing in terms of investor reception and the asset issuers that want to bring offerings on chain, as well as the utility that we're unlocking on these types of investments, I'm really excited about what we're doing. One of the new initiatives that I will and can talk about is a new blockchain that we're developing in partnership with another company in the space called Athena. That blockchain is called Converge. And we're hopefully only a couple weeks, months away from launch, but that should really be a big unlock, I hope, for RWAs and tokenized securities as we really try and cement a home for them where they can pretty seamlessly interoperate with things like DeFi, so investors have new opportunities to make their investments even more useful as they do them on chain. So it's those types of innovations that I'm really excited about, and getting to be on the ground floor is obviously a really unique opportunity.
Yeah, sounds super fun. I want to ask a final question of just, people curious about Securitize, the products you're bringing to market. I know the VanEck one just a few days ago that just launched. Where can people keep up to date with what you guys are building, and also where can they access these actual assets to potentially learn more about and invest in?
Yeah, so follow us at Securitize on X and on LinkedIn, things like that. Obviously, coming to the Securitize website, that's where you can access all of these products. So most of our products are for accredited investors or qualified purchasers, but that is where you would actually go through the investment process and be able to subscribe to the various offerings we have.
And just because you brought up one more for you, I want to ask about the accredited investor status, because there are a lot of conversations going on about those policies and those rules historically tied to wealth or salary, net worth. A lot of people, others are saying this should be tied to education, should be tied to other metrics.
Yeah.
Do you or Securitize have a formal stance on that?
I don't know that we have a formal stance on it, but I'm happy to riff on it with you for a second. I think in general, our regulators have positioned themselves most of the time in the right way, which is that they're mostly disclosure-based regulators, meaning that if all the proper risks are disclosed to you as an investor, if it's your money, you should be free to invest it how you want, in the size that you want, etc. And so it is my belief that, if you can meet a certain threshold of knowledge or education or something like that, as opposed to making it based on income or net worth or licensure, like having FINRA licenses, then you really should be able to allocate to the things that you want. And maybe the accredited investor definition is one of those things that may be up for changing in this administration.
Well, a lot is changing, and you're at the epicenter of it. So, Michael, thank you so much for stopping by, and you'll have to come back. Sounds like you guys are shipping stuff all the time. Tell us about all the latest and greatest that you're working on.
Would love to come back. Thanks for having me, guys.
Thank you. All right, guys, now we're going to turn to our typical coverage of the markets. It's been a busy week. Shay, you're in risk on mode as of, Monday, Tuesday. How are you feeling I can't believe it's already Thursday. How are you feeling a few days into this week with the relief rally?
As cool as the PPI print we just got this morning. I will say, I think we're going up too fast. I will acknowledge that. I think remember the RSI metric that I love. A lot of people don't love to use, but I use as a reference of oversold or overbought. April 7th. It was at a 20 on the daily and 25 on the weekly. I was like, all right, I think a lot of fear is being priced in. I could see anything below 30 is oversold. Now we just hit 70 on the daily chart. So typically anything over 60 is overbought. I think we're going to have somewhat of profit taking, especially from the people who bought on that recent bottom, because, again, they're kicking the can down the road 90 days. Like, the tariff negotiations better than feared. However, the foundation is still shaky. Like, we're still not past it. And I think that it's premature to assume that we're going to hit all-time highs when we're still kind of in this negotiating sandbox. So I love to see it. My portfolio hit an all-time high this week, and it's making me. It's a lot of retail bought the dip. That's the thing. Like, when are we going to stop calling them dumb money? For example, like, they are just like institutions went on the sideline. April 5th, April 7th was the bottom.
Yeah.
That they literally sold out on the bottom, and retail was all the buying that was happening past month was from retail. Yeah. And again, proving it looks like another V-shaped recovery, and retail has been buying that dip. Eventually, fine, maybe it turns into a multi-year bear market. But the past 2 years, retail has been like having a shutout against institutions, and dumb money is beating smart money in this game.
Yeah, brokerage firm Public put out a chart showing their investors buying the dip, And I'm glad you brought it up because they really nailed the April bounce. So retail investors are up 15% since the S&P bottom. And, JP Morgan is talking about easing off the gas, taking profits, rotating to safer bets, and retail is just leaning in. And so they're reporting retail portfolios up 15% since April 8th. And to your point, at what point is this not the dumb money? At what point? And just also, what are the dynamics at play? Is it the collectivism among retail investors? Is it how they're doing their research? Is it just their long-term conviction? What is it about them that are positioning them so well? But I'm glad you brought it up. It's a fascinating trend to watch. And obviously, congrats to all our viewers who have hopefully been a part of that move. Before we keep going in the headlines, I'm going to do a quick break for a message from our partners at Grayscale. Of course, Grayscale has been generously our presenting partner for this week as we dive into all things crypto. Grayscale is the world's largest crypto native asset manager with over a decade of experience helping investors get into crypto investing. So if you're thinking about crypto, you might want to explore and potentially start investing in Grayscale. You can look for their investment products directly in your brokerage account or visit grayscale.com for more information. And I think we got
Looking to add a Bitcoin fund to your portfolio? Do it with the Bitcoin Mini Fund from Grayscale, the lowest cost way to get exposure to Bitcoin in your investment account. Just search for fund ticker BTC wherever you invest. The Bitcoin Mini from Grayscale. Think crypto. Invest Grayscale.
And just coming in, we have some notes from Powell. So he's cautioning about higher long-term rates, citing supply shocks. So if you were thinking he was going to make some moves, probably not. He's sounding the alarm on the long-term rates, warning they could stay higher for longer. And I would say the translation is don't expect 0% interest rates to come back anytime soon. He's also saying, the U.S. is entering an era of more frequent and persistent supply shocks, which could make inflation as a concept more volatile and complicate the Fed's policy. I think this is a really interesting point of, prior to COVID, supply chain wasn't something a lot of people were often talking about it. Now with the tariffs, various geopolitical things at play, he's saying basically the VIX of supply chain issues is going to stay up, and it's going to change how they think about reacting to these things. Shay, I wonder if you have any thoughts on Powell's notes in particular. I know you've been pretty supportive and complimentary of his work so far. Any thoughts there?
Yeah, I mean, first off, before I get to that, I mean, I fully believe that deflation is here. I think for over a year now, or almost a year, we've been clinging to the hope that inflation was cooling and rate cuts are on the horizon. Like every CPI print, PPI print, every jobs report, even every time that a Fed official speaks, we treat it like a clue and a mystery that the market's trying to desperately want to solve, like it's a great YA novel. But the truth is, it's not a mystery because the bond market is screaming what's happening right now. I think that underneath these headlines and data print lies a different driver, and that driver is the fiscal plumbing in the U.S. government is broken. We're issuing trillions of dollars of new debt into a market that no longer has a reliable marginal buyer. The Fed has clearly stepped back. Foreign buyers have turned cautious. You can maybe call it due to the tariff wars, but they're cautious. They're not really buying the debt anymore as much as they used to. And the deficit isn't shrinking. It's actually accelerating. So that in a way is where the danger lies, because I do think Powell's stuck. So the reason I think he's stuck is if Powell cuts rates too soon, you risk reigniting inflation from the wrong side of the engine. But if he stays too tight for too long, you then accelerate the credit tightening, the liquidity stress, and the layoffs we're going to see, especially in white-collar jobs. Either way, the underlying structural dislocation, the mismatch between how much debt we're issuing and how much real demand there is to absorb it, doesn't go away. So I do think that this really isn't about rates at all. It's just about a regime uncertainty where market just doesn't trust the fiscal authority anymore. It doesn't believe that the central banks can cut without some kind of political backlash. It's more of a game now instead of actual fiscal policy. And there really isn't a coherent plan to stabilize demand for treasuries that isn't going to bid risk assets with conviction. So like it's in no man's land a bit right now. And it's tricky. It's dangerous. And I do think deflation is more of a reality than what the market is indicating, and I want to see him cut rates this summer. I just don't think it's going to happen.
I'm glad you brought up this like signal chasing, because I know this is probably not going to hit with a lot of our viewers, but if you're a Taylor Swift fan, you're trained to like look for Easter eggs, and I feel like it's like this is what's happening now. It's like, what does that word mean? What does this little thing mean? And then you're extrapolating out to try to get some alpha somehow. And to your point, it seems like a lot of that is fundamentally changing, and a lot of it is looking at things adjacent to actually what the Fed's actually doing. So it seems like a fascinating time to be in, like focused on macro, but also a very tough time for Powell. I wonder how he's coping. Hopefully he's got a big team he's leaning on. But yeah, you're kind of damned if you do and damned if you don't, and you just got to go with your gut and see what happens and be ready to adjust.
100%. I mean, nobody wants his job right now at all. Like it's a tough job. Like I do think I do think the deflation signal is absolutely real. And yes, like under normal conditions, I do think this data that we got today and even yesterday, CPI and PPI were great prints. Like it would justify a cut, but I don't think we're in the normal environment at all. So this is what happens when a monetary system outgrows its fiscal anchor, where inflation is falling but rates aren't, and everyone's like, "What's happening? This doesn't make sense." And when the data says go and the market says don't trust the brakes, like that's where like, oh man, nobody really knows where the signal is, and we're just gonna be stuck a bit.
Yeah, that's what makes it fun and exciting at the same time. And obviously Trump has been putting a lot of pressure on Powell. He's also putting pressure on Tim Cook. So making some comments this week, this time over India. And we've talked about this, Shay, of Apple sort of getting ahead of the China tariffs, moving or committing a lot of the manufacturing to India. And Trump coming out and saying publicly, I do not want you building in India. So he's emphasizing he wants this to be in the U.S. There was a lot of commentary around the feasibility of that, the potential pricing implications. And as you called out, Jai, Apple has been gradually doing this for years. India is becoming a growing hub for assembling iPhones. And so this I wouldn't say this was out of left field, but Tim Cook's probably, waking up this week and he's like, I guess I'm the target this week. And it brings us back to the conversation we've been having of just feasibility of bringing some of these manufacturing jobs back to the U.S., given the cost of labor stateside. So I know you've been, remember last time we talked, you were pretty encouraging of Apple moving to India. Do you think there's a reality where these jobs end up in the U.S.?
Eventually, but it's not a flip of, you can't just move a supply chain and all of a sudden, like a snap of a finger, like it could be somewhere else. Like it takes quite some time to replicate the infrastructure on the East plants domestically or even in India. Like for India, for example, like Tim Cook wasn't sleeping at the wheel. Like 5 years ago, he started initiating a plan to diversify the supply chain away from the East towards India. Like 5 years ago, there was no iPhones that were getting sourced out of India. Now it's 20%, but that took 5 years. It's going to take some time. That's in India. And domestically, who knows how long it's going to take. The pricing, the economics of it, it's not on the same level playing field as those two nations. So, and we also have the expertise, like a Foxconn plant. Like we just don't have that domestically or in India. So like, I think this is more of a just noise. It's not really any substance. Like I do think that Apple's going to have more of a domestic presence, but it's going to be, the primary driver will be India. It's going to be India. And the secondary is going to be domestically. And then I do think that in 10 years, like the reliance on China is actually going to be drastically different. And we might look at this tariff war as like that was the inflection point that we absolutely needed for America, patriotism. whatever you want to call it, that really pushed the trajectory of being so globalized with the East and West that finally we cut through it and we're just going around it. And yeah, I think it's a good thing. But Tim Cook, I think Tim Cook has a lot on his plate. It's not just like he has to deal with Trump and he has to deal with the lack of innovation internally. It's just like craziness on his world.
Well, that's why he gets paid the big bucks. Let's stay east, but not so far east, because obviously a lot of the headlines this week are around Middle East. A lot of activity happening there with the Saudis. We have Super Microcomputer up over 15% on news of a $20 billion AI server deal with Saudi Arabia's Datavault. A lot of deal making happening in a very short amount of time. They're also offering new liquid cooling systems aimed at reducing data center energy costs. Raymond James giving the stock an outperform. SMCIs keep climbing on this sort of Saudi momentum. Do you think are they an under the radar winner in this entire data center trade?
Well, I could tell you they just cut the line from China. So I mean, they have stupid amount of money. So like, it just makes so much sense for them to like, oil is just a commodity that's never going to gain its spotlight like it did past couple of decades. So what's next for them? Like, they don't want to be a dying nation that's going to be relying on this commodity that's just gaining less and less popularity. Go to the next frontier, the fourth industrial revolution, AI. So they're positioning themselves accordingly. And Trump literally made so many deals in his trip to UAE. Like, he was just like, deal, just throwing it out. Like, we got it. The amount of handshake. His wrist is probably sore from how many handshakes he was making on that trip. But yeah, I mean, it was great to see. I love it. I love to see it because I think every semiconductor got a bid from that news, because everyone, like Supermicro, NVIDIA, AMD, they all just like got pretty big deals, and it just was another validation that the engines of the fourth industrial revolution is humming, and it's not just domestically, it's going to expand globally, and Europe has a lot to catch up on as well. So like, it's just, there's a long runway for AI.
Yeah, I wonder what the concessions were, because the Saudis have been historically economic partners with China. What in the background are they committing to as part of these deals, as we have the ongoing tensions with China? And also, when I see these headlines this week, I'm thinking about, I think it was a week or 2 weeks ago, Disney announcing an Abu Dhabi theme park. Seems like a lot is happening over there in a few weeks. And historically, when you look back, you can kind of connect the dots. It's a little easier to do in hindsight. But definitely somewhere to watch. And it's funny, we were only talking about China, and this week it's, MBS, it's the Saudis, it's everything that's going on there. So a lot of activity to follow. And Shay, I guess my other question for you, and I know you don't focus on like oil stocks, but like you say AI is the new oil. Would you think about someone who's typically investing in that space in oil? Is that becoming something that's less interesting to investors as they think about other areas of opportunity, or is it that's always sort of going to be part of the energy equation, and the AI is a layer on top of that?
No, I mean, that's a great question. I think the economy is evolving. There's a new derivative of the economy. I call it the new digital economy. And that's why AI is the new oil of this new digital economy, because the same way in the previous one, oil was huge. Oil was at everything. Every single thing like needed oil. And it was like in third industrial revolution, like it was all about oil. It was the engine to make that revolution humming. AI is going to be in every single thing. Like this morning, you just saw Walmart make an announcement that they're going to start adjusting their shelving for AI because they believe AI agents are going to be shopping in the future. That's just AI agents. It won't be as many FT people. So that's just a physical AI component. But you're seeing like it's not just towards enterprises. It's not just models, hardware, servers, etc. Like that's the first phase of it. Sure, absolutely. But it's just like in the .com era. The first phase was the structural arteries of the internet, the servers, and I mean not the wires, and like everything that Cisco, Verizon, AT&T were doing, laying down the groundwork for what the internet was going to become, the connectivity of the future. That's essentially what's happening right now. Everyone's just focused on the hardware component, but applications, like it's going to go bonkers, and AI is going to be in every single thing you do. That's why maybe Best Buy experiences a massive renaissance, because every kitchen appliance that you have right now will probably have some kind of AI infusion in it, and it's going to cause a lot more people to buy these kitchen appliances because, oh man, I have to actually walk over to my toaster oven and click like on and like medium toast in like 15 minutes or whatever. Like in the future, it will be toast intelligence, where they just like tell you exactly, like they ask you, like, oh, how much do you want the toast to? I was like, remember that toast I had like 4 days ago? Like that was the exact level I love. Do that, replicate that. It's gonna be that kind of conversations, and everyone's gonna go bonkers over it, especially in your fridge. Like they're gonna, maybe in the fridge they're gonna flag like, this one's expired, like toss it out, and just go on Amazon Prime, put it in your shopping cart, and by the time you get like you implement on Amazon Prime, like until I get like 15 items, don't order, but as long as I need 15 items, then order for me without me even saying it. Defaults, just like that subscribe and save feature on Amazon Prime. You can do that for buying groceries. Like I'm saying, it's just like these are all the applications I'm just thinking on spot. But like you just see how it's just so much runway.
It is fascinating to think of with the AI being more like front page. I think AI has always been in the background of these systems, and now we are directly seeing it. And it's sort of making our decisions more automated and passive. Do I, when you go to this run out of milk, you go to the store, maybe one of these times you're like, oh yeah, I guess I'll get the oat milk this time instead of this other kind. You'll make like an instinctual human decision. It's interesting as you paint that picture. I'm thinking about, do those spontaneous, serendipitous moments of discovery or making a mistake, does that happen as often when it's like, this kind of milk is low, let's tell Amazon, 2 days later that milk shows up. So it does change a lot of how these retailers think about bringing products to market. I did not see the Walmart news, but that is wild. But also not that much of a stretch. I go to the grocery store now, and most people there are shopping for other people. So you have the human extension of these technologies doing it now. Eventually it could just be automated. So Walmart also announced that they're going to have some price hikes coming due to tariffs. At least they're saying it's due to tariffs because they're saying these are too steep for them to absorb, so some could jump by the end of May. So that's definitely something to watch. The other headline from their earnings, their sales rose 4.5%, so showing the resilience of the American shopper and consumer. And their e-commerce business posted its first ever profitable quarter. And so they're joining other brands, Adidas, Mattel, P&G, raising prices. And we'll see how people react to that. I think they have conviction in the strength of the consumers based on their sales data that should be okay. But lot happening in the retail space. Shay, Walmart is interesting. They're the OG brick and mortar, and now they're finally profitable on the e-commerce biz. Is that an interesting company to you as someone who's shifting from the old way of doing things to the new way of doing things? Or are you more focused on these disruptors that are actually innovating from the ground up and actually disrupting the people like Walmart?
I think Walmart's stupid overvalued. Like, I think it's the dumbest thing to buy this name over $75. I think the reason for that is like Amazon is trading at 30 times earnings. Walmart's trading at 40 times. What are you trying to tell me? You're trying to tell me Walmart has a greater commerce ecosystem than Amazon does? Like, people go to Whole Foods, people go to order on Amazon Prime, but that's 25% discounted than going to some Arkansas Walmart store in Middle America, who's going to be Middle America is going to be broken forever, and people aren't realizing that. Like, it's going to be so freaking bad in the agentic AI world we're about to. I'm not trying to like spread FUD. I'm just saying, like, white collar jobs are going to get diminished 40% minimum, and you're going to see the transfer of the delta of wealth between really wealthy to people making $200K a year as a family. Those people are gonna, I don't know how they're gonna survive. I really don't think it's gonna be difficult. They're gonna have to really adopt AI and to create something themselves, because relying on an employer you can't do that anymore. There's no world you can do that anymore, because it's just, they're gonna continue every year. Is gonna be layoffs. It's not just gonna be, I think before layoffs were cyclical. I think this is just gonna be an annual trend now for decades. So I think Walmart is one of those names where their bread and butter is middle America, middle class, and maybe even lower middle class, to be honest. And those are the demos that are going to get hit the hardest in the next 10 to 15 years. And I do think the Walmart family's been dumping a stupid amount of shares as well recently.
Yeah.
So I just don't see the case at Walmart at all. It's not like they have a Walmart Web Services, like a compute engine like Amazon does. I just don't understand why they're so expensive. It's like Costco's better, Amazon's better, but Walmart has a 40 times earnings multiple. Please tell me why.
They got to build that cloud business. Speaking of the layoffs, Microsoft, the layoff data to me is so fascinating to see beyond just the volume. Where? Like which job specifically? So take a look at this. This is recent layoffs at Microsoft. Software engineering. Yikes. Like that, if I'm an engineer, I'm looking at that and I'm like, holy shnikes. Of course, Microsoft in their earnings call 2 weeks ago saying 30% of the code is done by AI. A lot of times these companies, the commentary is, oh, this is just accelerating what our talent's able to do. But I think this is the flip side of it, with the reality of it. And even Vlad was on and saying he thinks it's over 30% AI written code at Robinhood. So software engineering, product management, design though, which is one where I think a lot of designers are worried about Gen AI tools and design. Very minimal impact comparatively to software engineers. So I don't know. I look at this and I'm like, man, Shay, like if you're a software engineer, what do? Like, what is your move here? Because this was, 10 years ago, the most coveted. They were paying kids $250,000 out of college to go to Google and code. And it hasn't been that long since those days.
So they're screwed unless they learn a new skill set. Like emotional intelligence is the new currency in the future world we're about to enter. Like you can't just be high IQ, be on a computer screen, be a high operator, because guess what? If you have no semantic layer in what you do, semantic edge in what you do, or any kind of above average emotional intelligence, you are ripe for disruption in your life. Like I being able to for perfect example, anecdotal evidence I have on my end. I am not the brightest in my career on the teams I'm at in my career. I'm not. I'm intelligent enough. 70% of the way there. What takes me to the finish line is my ability to narrate a story, digest data, and communicate it in a digestible manner for C-suite, the leaders who actually can make the decision making. The people, the data engineers, the data scientists, the people I work underneath me, again, highlight underneath me, is because they can't take the next thing of like, they can pull the data, they can manipulate data, create a model perfect, but that's all they can do. They're capped at that. They can't really take the next step of communicating what to do with it. Those are the individuals that you guys got to learn that skill set now. It's like, I know, I hate it. Everyone hates public speaking. I didn't like public speaking. I never, in high school and college when I took those courses, I never in my wildest dreams think I'd go on TV to talk about stocks or go on this talk show every single morning, talk in front of thousands of people. Like I never would have thought that because I didn't enjoy it that much, but this is the world we're about to enter, where you gotta push yourself outside of your comfort circle to learn those emotional intelligence tools, to learn how to create a story and communicate it on something as binary as data pools. So like, I think these engineers, like they aren't great at like they're sassy, they're very emotional. Like the people, you'd be surprised, and like it's because they're being used left and right from leadership. I get it. Like you guys are abused for how much you actually have to work. I totally get that. And you're not like recognized at all because you hand off the data and the person communicating it, like myself, gets all the credit. Even I say, oh, it's my team that did it. It's not just my credit. Nobody believes that on the call. They just identify, oh, Shay did this, communicate this model, and Shay did this because he took it to the finish line. So these engineers, like, you got to learn how to. I'm not surprised. Like, engineering is not the skill set you should learn anymore in college. It really isn't.
I get the sassiness though, right? It's like that Mad Men quote. It's like, oh, she just like, you never say thank you. And he's like, that's what the money's for. I mean, you're 21 years old and Google's like, hey, do you want to come make a crap ton of money and live in, beautiful San Francisco? And like that is a huge shift over time to now. some of these tools sort of replacing what they're doing. They've gone from like god-like figures to number one on the chopping block. And that's wild. And I think I was trying to see who said this quote, and I can't find who originally said it, but this concept of ideas are only as good as your ability to communicate them. And I cannot figure out who originated it. It might have been Bill Gates, but it's one of those things like The Office where it's like Michael Scott, Wayne Gretzky, like, I don't know. I think that's what you're getting at, Shay, of the ability to sell an idea, communicate an idea is almost as important as the idea itself, because it's easier to generate those ideas with all of these tools and all of the generate the work. So how are you pushing that through? That's EQ, that's emotional intelligence. But man, wild times in corporate America, solidarity with engineers. I'm sure you guys will figure it out. You're a smart bunch. I want to shift really quick in the final few minutes of a couple of fintech IPOs or S1s that are being filed. So eToro went out. They had paused their IPO. They went out yesterday, had a great day. So the stock popped. They are, and I want to get your thoughts on this one, Shay, because now we have Robinhood out there. We have Webull, eToro. So a lot of digital brokerages. You have the Coinbase on the crypto side. We talk about commoditization. A lot of these platforms offer similar products with different UX wrappers. And I'm curious if you think, do companies in this space need a moat, or is it the case that there's going to be a lot of brokerages and there's room for more than 1-2 dominant players?
Yeah, I mean, there's definitely room for more than 1 or 2 dominant players. Like, for example, I think Robinhood, that UX wrap that you talked about, that's their mo. Nobody can really replicate that in that space. They've tried, they failed. User experience was a small rock before in this industry. Now it's a massive rock because you see that the premium that Robinhood's trading at when everyone else is dreaming of it. eToro has a great. eToro's difference between eToro and Robinhood. Like Robinhood is very much U.S. domestically. Mm-hmm. It's slowly expanding internationally. eToro's in like 100+ countries. Like they're fully international. So they have that. That's their like specific moat, in my opinion, is that international angle. And also like I think they have something that's called copy trader, where like, users can automatically replicate trades of top investors. That's massive. I think a lot of times people want to not do the work, not put the effort, maybe because they don't have the time, work 40, 50 hours a week in their 9 to 5, or just don't have the confidence in doing so. But they see individuals like myself or like people online who do this every single day and talk about it, and like they believe in what we're our stories that we're saying and what we're bullish on. And like, I like that story. I like him or her. I'm going to follow that person. That's the copy trader element I think only eToro really has. So like, I think there's nuances for each name.
Yep.
It's just, you have to ask yourself what's going to actually gain momentum and build up.
Yeah, there's so much innovation happening. I mean, even at the top of the hour when we're talking about tokenization, that's so fascinating to me. But even when we're talking to Vlad, and he's talking about this agentic AI layer where someday you'll be able to input a lot of parameters. It'll do the trading for you. I know Robinhood, as a competitor public, they actually announced sort of this Gen AI portfolio builder, fund builder tool yesterday where you can say, I want to invest in companies where 20% of the C-suite runs marathons and it's in cybersecurity and the market cap's over X, and it'll go through the data and find those companies for you and invest. So there's this sort of, it goes back to sort of the engineering angle. You can, without having the coding skills, with the right conviction and philosophies, these tools will start being able to build those strategies for you and actually execute on them. And it goes back to what you're saying, Shay, of like, where's the idea coming from? How are you communicating that idea to other people or the tool? But it is, I think it is like, we're kind of entering this new renaissance of money movement and transactions. And I think you're starting to see that in the public markets. Chime also filing their S1. That's a popular neobank, a sort of mass market product. There's a few other neobanks that are very large too. Current is one that is private. So I think one of the things to watch, which we've talked about, is this transition of power and influence from these old school financial institutions that have always been around, since, you know, the 19th century. And now you got Chime, you got Robinhood, you got eToro. How does Schwab react? You know, how does JP Morgan react? I'm curious if you have any thoughts on that, because those companies are very obviously well funded and have a lot of capital. They should be able to compete, but do you think they even have a chance with all these upstarts now entering the market?
All right, so I'm going to end with my tangent, like a pretty big Shy rift right here about fintech, because I'm a thematic investor. I'm bearish on fintechs because the fintech story, like you just mentioned, has always been sleek. Like, it's about disrupting legacy systems like the Schwabs, like the JP Morgans, Wells Fargos, unbundling all these banks and then rebuilding the financial stack around the user. And for a while, it worked. It was a sexy thing, fintech, especially in 2020, 2021. Why was that? Capital was cheap. Growth was the only metric that mattered. And the sheer inefficiency of traditional finance left room for almost any interface with a clean UI and a decent onboarding flow looked like a genius. But under the surface, if you really look deep enough, very little has changed because most of the innovation was just cosmetic. It was just wrappers around the same underlying infrastructure, the same payment networks, the same custody rails. Like, it was essentially the same, except that there's makeup on it. And now that capital isn't free, and to be honest, I don't think it's like what Powell mentioned, really ever going to go down much lower to 0%. I think the cracks are now impossible to ignore because the core issue is simple. This is a business of facilitation, not ownership. Most fintech players don't control the stack. They rent it. And I do think that when your entire value proposition is built on distribution rather than defensibility, you're only ever one step away from being replaced. That's why I've been structurally bearish on this space, because when everyone's selling access to the same pipes, the only thing left to compete on is price, and that's going to be cannibalization of everyone's take rate. And price is a race you just can't win. Nobody wins. And again, I sound super bearish, and I think that maybe I'm wrong. Possibly. You guys fully acknowledge that maybe I'm really wrong in the fintech space, but I just think that most of fintech doesn't have it. I think as consolidation looms, I think as multiples compress, the cheap will look cheaper. It's always worth asking yourself, like, how many of these companies are actually building the systems? How many are actually just renting time? Because in fintech, time is the most expensive thing you can buy, and it's also the easiest thing you can lose. So right now, I think I put that whole theme in too difficult to understand, but there's few winners in that space that if you do deep enough that they're going to come out of this like thriving, like the next Robinhoods. But as a whole, I just don't see it at all.
I don't think that's a pessimistic mindset. I think that's a really good call out for people, because I've worked in fintech for a while. There's a handful of companies that like basically everyone else is built upon. Like Stripe's one. So many companies exist is like they add a layer on Stripe. And so as an investor, to your point, where are the systems? Like, who's fundamentally changing things on the back end? I think Securitize, like we had, that's an example. They are fundamentally changing the structural nuances of how money is being moved and assets are being allocated. And there are certain companies, Apex Fintech's a publicly traded company. Webull runs on them, Public runs on them. A lot of brokerages run on their rails. So that's a company, everyone knows Robinhood. You don't know about them, but a lot of companies run on them. So if you're interested in fintech, you could actually go on their websites, look at the fine print. It says they have to disclose all the things they're built on, the systems they use. This goes for neobanks built on top of other banks, card issuers. It's really fascinating, and I think, Shay, it's a really important point to look at what's underneath the surface and what are those foundational building blocks? Who are those companies? Because that might be the place to look. And which of these companies are actually building things structurally?
Also, it requires a skill set to identify those characteristics. And what does eToro offer that no one really else offers? Copy trading. So if you find someone who knows how to identify systems in the fintech space, kudos. You don't have to do the work yourself. Just follow that person. So same with AI. AI tsunami is coming. You have to figure out what infrastructure works or not. But it's a dangerous theme to be participating in.
I'll say one quick note on eToro too. I think the other move, just being kind of in this world, the fact that they are global in a regulated environment like investing, that is such a head start. It takes years and years. If you recall, Robinhood tried to go to the UK. They came back. I think they're trying again. The fact that they're already in these markets is a huge head start. It takes so long because all the rules are different. They have to deal with the local government. So I think that, too, is like, again, you have to kind of know if you know. That's potentially a moat for them as well.
I mean, also the world does not trust U.S. So if you start as a U.S. product, like they're like the onboarding is a lot more difficult than you anticipate. Like even the U.K., like Robinhood's having a difficult time in the U.K. and the U.K. is like our cousin.
Right? Yeah, it's wild. I love to talk about these things. I know we'll talk more about eToro very soon. But Shay, thank you as always for your insights. Learned a lot today. And as everyone knows, we are live Monday to Thursday, 9 a.m. Eastern, and we'll be back on Monday with a whole other slew of news.